Hey YouTube, it's Matthew Decker with Leverage Wealth Management. I also run Cash Value Life Insurance reviews here on YouTube. Today, we are going to be talking about Index Universal Life Insurance policies and the different types of loan provisions that exist. Now, full disclosure, this video is going to come to a relatively abrupt end. I started talking about this. I wanted it to be about a 10-minute video. It turned into a 20-minute video, so it's going to be coming to you in two parts. That's the first thing. The second thing is my camera stopped working halfway through, but it was some good information and I had a screen share going, so I figured we'd just upload the screen share with the audio, and I hope that you enjoy. Today we're going to be focusing on loan provisions, and it's going to be a relatively short video. I've done videos on loan provisions before. If you want a really in-depth video on loans and how they work, you can check that out. Up above here on the video card, we'll put a tag in there so you can check out that video. We'll put it in the description below as well. But today, I want to try just to make it super easy. So there's different types of policy loans. And the first type of policy loan is going to be super straightforward. That would be known as like a wash loan. Might also be known as, it could be called a fixed loan, or I suppose it could also be called maybe even a standard loan. And these are pretty simple. Your fixed loan, your wash loan, your standard loan, the company is going to charge you a certain rate. So let's call it maybe between 1% to 3% in the first 10 years. And inside those 10 years, if they're charging you 1% to 3%, they're probably going to credit you back less than what they charge you. So maybe if it's a 1% to 3% charge, maybe these fixed loans are going to have a 1% to 2% credit. And I actually don't think there's anybody out there that has a 1% charge inside those first 10 years. After you get outside those 10 years, it's going to move into what's called a wash loan, more likely than not. And that would look like, they charge you 2% and then they're going to credit you 2%. And what that effectively does is it's just a loan that's going to kind of cancel itself out. It's going to grow just as fast. The policy rather is going to grow just as fast as the loan balance is going to grow. And this wash loan, standard loan, fixed loan, however we're going to call it, it's the most conservative form of loan on these policies. And most people don't use them if they're trying to generate, maximum income with these policies. So that's the first type of wash loan. I will say that just about every single company doing business in this space has this type of loan provision. There's maybe 2 or 3 that after the 10th year don't have a true wash loan where they credit you and charge you the same thing, or they might word the contract so that they're currently crediting and charging the same thing, but they have the right to increase the charge to a point where maybe it's not a true wash loan. So you want to be super careful of that. There's a couple companies out there that do that. And in my opinion, there's no reason at all to do business with those companies because they're the only ones that treat you like that. They're the only ones that actually don't give you a true wash loan. And why even go down that path if they're not willing to kind of do what the rest of the industry is more than willing to do, and that is give you a true wash loan in the 10th year plus. Okay, so that's wash loans. The next type of loan, they're both going to be participating loans, and I'll explain that as well. So a participating loan simply says that you take money out of the contract, but the company is not going to take those dollars out of your index. So if you take let's call it a $50,000 loan in some year, and it goes into your bank account, the company's saying you're still actually going to earn interest on that $50,000. Yes, we're going to charge you a fee for the loan, and that might be anywhere between 3% and 6% for that loan, but you're going to earn your indexed credit. So if you get a 10% in the index, your loan balance is going to grow, or rather your loan is going to get credited 10 and charged maybe 5. Okay, that's a participating loan, and those are a little bit more aggressive than the wash loans. But for that additional risk that you're taking on, you have the opportunity to actually outperform your loan rate. And if you can do that over the long haul, this results in a hugely beneficial loan provision. Okay, so that's a participating loan as a bucket. Participating loans come in 2 forms. We have variable loans and we have fixed loans. So there's a variable participating loan where they'll charge you, let's say, current rates, but it can go up or it can go down. It's just based on the current interest rate environment. Typically, those variable rate loans are going to be tied to the Moody's corporate bond yield. I don't really love variable loan rates unless they have a stated cap, and we can illustrate the policy using the stated cap of the variable loan rate, because then we're able to basically take a variable off the table and it makes the projections more solid. So that's variable loan rates. You should know that some companies have variable loan rates that can go as high as 8% or more. And so that's why I don't really love that type of loan provision. The one that I would prefer is a fixed participating loan rate where you have a contractual guarantee on the loan rate itself. So you know what it's going to be from the jump. It might be 4% contractually guaranteed, 5% contractually guaranteed, 5.5%. It doesn't matter what the rate is. The point is, it's fixed, it's not going to change. And therefore, on the illustrations, when you are looking at income projections, you know that one of the variables that's not going to work against you is what rate is the company charging you. All right, so that's where we're going to cut it off for this particular video. In the next installment, we're going to talk about some of the flexibilities that you may have depending on what type of loan provision you choose. And we're also going to look at some different examples tied to specific companies. Hopefully this has been helpful. And until next time, take care.